welcome to another session of Unlock the Stock. As you know, this is a platform that is designed for retail investors to gain access to corporate management and to get to know them and their companies a bit better. This episode is sponsored by Easy Equities, the platform that helps you grow and protect your wealth, where you can invest in local and international shares, property, unit trusts, cryptos, bonds, and actively managed ETFs. Plus, you get access to Easy Protect Life Insurance and Easy Credit Lending, which will back your financial journey. We're pleased to welcome back to Unlock the Stock Attacq, which is here for the fourth time. And we're joined today by Jackie van Niekerk, the CEO, and Raj Nana, the CFO, who will be taking you through a presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. Please visit their website, which is lumiglobal.com, to learn more about their various online AGM and investor presentation solutions. Our hosts this afternoon will be the Finance Ghost and Mark Tobin of Coffee Microcaps, who will lead the Q&A session. Before we start that, there are just a few housekeeping notes. Jackie and Raj will take you through a presentation that will be followed by Q&A. You can post your questions by typing them into the Q&A box at the bottom of your screen. The event is being recorded and will be available on our Unlock the Stock YouTube channel soon, together with about 40 other videos that you can take a look at. You will see an email address when we begin the Q&A session, and if you would like to be added to Attacq's distribution list, please take down that email address. Jackie, at this point, I'm ready for you to share your screen and to take us through the presentation, please.
Thank you so much, Vanessa, and thank you for the opportunity, and good morning to everyone. And we are delighted once again to be with Unlock the Stock. I think it's that one.
Beautiful.
Yeah, and then share. We're just getting the presentation loaded. Vanessa, maybe if you can just confirm that you are seeing the presentation.
Great. We're seeing it. You'll just put it on the big screen. Okay.
There we go. Excellent. So I'm joined by Raj Nana, our CFO. We're also going to play a bit of musical chairs here today. I'm also joined by David Westhuizen, our development executive, and Michael Clampett, our asset and property management executive. There's so much on the go, so we thought let's bring in the impact players also here today. So we will be playing some musical chairs and really enlighten our listeners today on a bit more in depth of our precincts and also the development activity that is undergoing currently at Waterfall Junction. But just who we are from a business point of view is we listed on two platforms, the JSE and the A2X market. Our share price ranges between 13 to 14 rand, some good days 14 rand 50. But I think very important to stand still is the discount to our net asset value, that ranges between 20 to 30%, which is one of, I would probably say, the better trading stocks currently on the JSE. Our portfolio value, 20 billion, which represents 62 properties with a GLA of just under 800,000 square meters of GLA. Very healthy occupancies in our portfolio of 93.2%. And we'll unpack a little bit today also, what is our focus areas when we look in the next slide on the diversification in our portfolio, and then what is the focus areas for us going forward and from an investment and capital allocation point of view. Very healthy collections. We always say with no rent, we can't pay salaries or our shareholders dividends. So it's always encouraging to see the 100% collection rate. Just again, the fundamentals that we drive in our business is if we get the basics right, the rest will take care of itself. Our development activity currently in the ground, just under 90,000 square meters, which also represents over 2.3 billion rand of investment. This is excluding the infrastructure investment that is currently undergoing in Waterfall, particularly in the new pocket of Waterfall Junction we're opening up. And we've asked David to just chat a little bit today about why is Waterfall Junction so special and why we are so excited about opening up this incredible piece of logistics precinct as a next phase in Waterfall. Gearing, which I believe is one of the lowest and best balance sheets in the industry in South Africa. We 25.9% gearing and an ICR of 2.9%. And this also gives us a lot of runway for new development, investment opportunities. And we always talk about a sensible capital allocation. And it provides us really optionality of where do we provide funding to and which projects we select to invest into. Our energy mix, 9.3% currently of renewable energies target for 2028, 2030, 25%. And that really drives a lot of operational efficiencies in our business. As we all know, water infrastructure decay throughout Southern Africa has been a major problem. And we've been investing for a number of years in water backup, ensuring that when our clients are in our portfolio, they can trade uninterruptedly. And 72.2% of our portfolio have got 5+ days water backup in the portfolios, which means you can trade for a week with no water from council. And then we've got further backups to that. From an employee demographic point of view, a healthy employee composition. I think we're also one of the youngest staff corpses, really youngsters understanding what shoppers want. You know, what's the new generation shopper want, and how do they operate and work. Really gives us, great insights having those type of employees in our organization. 172 employees and a level 1 BE score that we've maintained over the last 4 years. When we look at our business overview, we really focus on precincts. So if you think about Attacq, you think about precincts and real estate in all precincts. We believe that a safe, sustainable space in a precinct where you don't just go to work and you park your car in the basement, you walk up and you work and you go home, but where you can actually walk in a park, you can live, you can shop, and really have a life centered around your office or your shopping environment or where you live. And that safety factor has become ever so more important, as well as the infrastructure that we provide to our clients. The quality of our portfolio, we've got a relatively young portfolio, diversified in terms of sectorial diversification, very much focused a retail portfolio at this stage. 32% is collaboration hubs, which is our term for offices. Post-COVID, maybe just to take a sidestep, we really decided to reframe offices to a collaboration hub, as we've seen that people can work from anywhere in the world and still work in the same company. But you really need the office for culture, collaboration, ideation, and hence we thought about, we coined the term collaboration hubs. And then logistics contributing 22% of our portfolio. Really from a strategic point of view is with opening up this big pocket of land, logistics we hope to grow in the portfolio and diversifying the portfolio even further with a greater exposure to logistics. Waterfall City is we always call it our unique value proposition, building a city in the middle of Gauteng, connecting Pretoria, Johannesburg. Really a very, very special opportunity. We've been involved here for over 10 years now. We've had some great success, and Michael will talk today about also the incredible multinational corporates and international clients we've able to attract and retain here in Waterfall. An integrated approach, so the 172 staff, as per the previous slide, it's a complete integrated staff portfolio where the entire mall staff, our handymen, our GROs, everyone that works in all of our malls are part of the Attacq family. So we really understand the pressures of the operational staff. What do they need from a capacity point of view, from a resourcing point of view, and really ensure that excellence comes standard in our portfolio, because we understand what needs to happen on every precinct and on a granular level. Business diversification and innovation. We really like to push the boundaries within our real estate. We don't always follow the rule book. There is no box in Attacq, and we really try and always introduce new innovative ways to attract clients and retain our clients in our portfolio. A very important part of our business is our people. Without people, a property it's just bricks and mortar. People bring life to it, and the people in Attacq bring life to everything we do in our precincts, how we look after our precincts. So we're really proud of a purpose-led, collaborative company culture, which is also then to the next point, where we feel in Attacq it's also important to uplift the communities where we operate within. And then largely, we invest, engage, and collaborate with our communities and on a larger scale as well. I've asked Rech to maybe give us a bit of feedback on our share price and performance.
Thanks, Jax. So if you look at the graph up on the right, it really plots the Attacq share price relative to the SAPI index. And that's effectively the 20 largest property counters on the JSE, not necessarily all REITs. And you can see from the graph that there's been a substantial improvement or recovery from the listed property sector over the last 3 years. So this starts 1 July 2022, so just shy of 3 years. But what you can see is that the Attacq shares obviously outperformed the index by quite a substantial margin. So the share price growing by 2.55 times, whereas the rest of the SAPI growing by about 1.4 times. And then what we've done is also just plotted the relative dips growth from a Attacq perspective from FY21, and we've included our FY25 guidance, which is within a range of between 24 and 27% year-on-year growth. And you can see that post-COVID, we've had a substantial recovery and increase in our distributable income, which has led to ultimately what will lead to ultimately about a 23 to 24% CAGR over the last 4 years. So what do we attribute our success to? So I think one of the most material aspects of the recovery has been our revised capital structure, where we pay down a significant amount of debt towards the end of FY23, or rather calendar year 23, 2.7 billion rands worth of debt. And on the back of that and the re-rating of our debt, we refinanced the remaining debt of about 4 billion. That capital structure pay down allowed us to, one, access cheaper debt, but at the same time led to the re-rating of our share price. And since then, we've been redeploying or recycling capital. So we've exited a number of our offshore investments and redeployed that into South African assets where we own and control and manage those assets. One of those examples is the acquisition of the 20% share in Mall of Africa that we didn't own, which we concluded on the last day of the previous financial year, and a number of other smaller exits, and really focusing on assets that we control, own, and manage, rather than being minority shareholders in investments that we don't influence or we don't control. The transaction that we did with the GPF obviously helped revise the capital structure, rebalance the capital structure, but it also introduced a third-party investor effectively into Waterfall City, and at 30%. And what it has effectively allowed us to do is own 70% of the assets, but asset, property, and develop, manage the Waterfall City project on behalf of our investment partner, being the 30%, and for that we earn some fees, which obviously helps our overall return. I talked about our lower cost of debt. I've got a slide a little bit later on to provide a more recent update on how we've been managing the debt, and we've had some great wins over the last 18 months. But ultimately, if you look at the quality of our assets, I think they speak for themselves. So Waterfall City, a very unique and what we call a unique value proposition relative to our peers in the listed real estate space. Waterfall City being anchored by one of the best super regional shopping centers, being Mall of Africa, a 6.2 billion asset that grows from strength to strength. And then the precincts that we have outside of Waterfall City being Linwood Bridge, and the regional shopping centers that we have, which are dominant in those areas that they operate in. And I think the quality of those assets are well understood by the market.
Thanks, Raj. If we talk about our purpose and our strategy in Attacq, we always believe that our mission and our values are critically important for our staff, for our investors, our whole stakeholder community, to understand why and what is our golden thread of why are we here, and why do we get up in bed in the morning to come to work and do what we do. So as I've said, Attacq is foremost a precinct developer and owner. We believe in infrastructure development, create quality, sustainable precincts. We are the municipality. We look after the greater area, not just the real estate that our clients reside in, whichever gives us an opportunity to transform spaces and deliver an exceptional experience. So that's our mission. Our values in our business is very important, and it's very close to our hearts: accountability, collaboration, creativity, integrity, and sustainability, and always thinking about the future. And our vision to be client-centric and a trusted real estate partner for all of our stakeholders that we operate in. Our drivers in our business that we focus on, and that's also a big capital allocation focus, is Waterfall City, especially the developments in Waterfall City. That is the big component of where we invest and allocate our capital. We've also got an incredible South African portfolio, which Michael will touch on now, all the precincts within Waterfall and outside Waterfall. We'll also allocate capital to these precincts for upgrades, further expansions, to ensure that we remain dominant in the areas we trade in. And then on other investments, for years we had investments in the rest of Africa. In the last year, we disinvested in the direct holding of the assets, and we exchanged the direct holding for assets for Lango shares. But we've also invested quite greatly in what we call Attacq Ltd. That is PPA's power purchase agreement, as well as solar panel investments within our portfolio. Our enablers in our business, our long-term growth in our capital structure with a sound capital structure. As Roger said, our gearing, our balance sheet is very sound. Our people in Attacq, making sure that they drive the business and understand the drivers and what needs to happen within these drivers to unlock great value. With all of this, we always need to look at what the operational excellence is and how do you drive operational excellence. And when we've embarked on an incredible big journey and very important journey of becoming an integrated digital business, and we're busy expanding and evolving in our digital systems in our business, which really creates capacity for our teams to operate and create more great experiences for our clients. With our clients, our client-centric approach, we don't have a business. So a very, very important enabler in our business is how do we manage our clients and how do we look after our clients. And then the last part is the impact in our communities and our environment, and how do that contribute to our drivers and ultimately in our strategy, and then making sure that we meet our mission and our vision for our business. Mike, I'm going to ask you to take us through the operational portfolio.
Good afternoon, everyone. It's fantastic to be with you today. So on this slide, we've got a summary of our in-force property portfolio. It contains a lot of numbers pertaining to the number of leases we have. There's some trading metrics on there, turnover growth, densities. But if there's one number that I hope you remember from this slide today and take away, it's the number 6. Effectively, we run and own 6 precincts in South Africa. That means that our business is a very simplified business. We can transpose whatever learnings we have in these precincts to the other ones very quickly. And it also means that our business is effectively not made up of 100 properties scattered around the country, but that we have the opportunity and ability to really zone in into these 6 significant areas. There's also some familiar names here. Of course, Mall of Africa. I think Raj made a mistake earlier. He said it's one of the top super regionals in the country. I believe it's probably the top one. It was the Challenger Mall in Gauteng 10 years ago. It's really found its feet, reached sort of a level of maturity that today, when some international retailers enter the country, usually Mall of Africa is one of the first conversations that they do have. Mall of Africa, of course, is situated within Waterfall City here in Gauteng. David will tell us a little bit more about the tremendous development potential that's still available to us here in Waterfall City. But it's important for an investor to also keep in mind that although Mall of Africa today is quite a significant capital allocation for us and a big asset, but the continued activity by David and his team in Waterfall City will continue to support Mall of Africa, its financial sustainability, as well as the sustainability of the retailers within that property. If we just turn our attention to Waterfall City, specifically the logistics and the collaboration hubs, you'll see a number of international blue chip names on here. What we have found more recently, since sort of the end of COVID, is that as these big multinationals have reviewed the way that they want to set up the offices, they've looked to Waterfall City as quite a unique value proposition for their staff. So you will see a lot of Africa headquartered companies for these international blue chips today here in Waterfall City. And also very proudly, you'll see a number of head offices for some prominent South African businesses, including Tiger Brands, also here in Waterfall City. The reason for this mostly is because it's more than just the experience within the building. For these big corporates, it's also the experience outside of the building. Waterfall City offers a lot of amenities, access to a lot of things outside of just an office. We make sure that the precinct is clean. We make sure that the precinct is safe, coordinating our own efforts with private efforts, also with government efforts. And that really makes it an easy choice for these corporates to come to Waterfall City.
Thanks, Mike. So chatting about developments at Waterfall City. So this is a map of the entire of Waterfall. We showed quite a lot in our results, but I think it's important just to touch on it because it's ever evolving. So essentially, Waterfall in total is about 2,200 hectares. We as Attacq aren't responsible for all of it, but we are responsible for a large chunk of it. So we initially started with roughly about 2.5 million squares of bulk that we could develop. We currently are sitting with just over 1.4 available to us. So there's still a large pipeline that we still need to roll out here. And the focus of that is going to be in the blue area and in the red area that you see on the map. So the blue area essentially surrounds the Mall of Africa, what we refer to as LP10 or Land Pocket 10, or the city centre. And then you're looking at the red, which is going to be our future logistics, which is Waterfall Junction. I think what is the most amazing thing about Waterfall is that the majority of the infrastructure here that you see is essentially privately put in, very modern, and that's really one of our big competitive advantages. So the focus, if we zoom into the two main land pockets that we're going to be looking at, so this is a 3D model of LP10 or the city centre, so you'll see Mall of Africa there. So essentially, Waterfall started from the western side of Waterfall and then has grown essentially going east. We are looking now at doing a lot more developments around the Mall of Africa. So as you guys have probably heard in the last few days, we have launched a new residential scheme. It's called Aspire. It's in the turquoise there. So that's going to be a JV with Tricult. Tricult are currently our partners on Ellipse. You'll see there highlighted in yellow is the third phase or fourth building, which is currently under construction and will be completed in October of this year. To give you an idea of the scale, Ellipse is about 670 units, of which we have about 20 left, so it's been a real success. And then Aspire, which we launched a couple of weeks ago, 217 units, of which we have sold 44%. So the development has been a real success so far. I think we're excited about it in that it's going to be attached to the mall. So it's going to provide more density to the road surrounding the mall, which is Carkloof, because we're going into a phase now at Waterfall where we are looking to try and activate the city mall. So the ground floor will be retail and will unlock obviously more activity, because Waterfall is not just going to be a commercial hub. You need to have people living here and activating the city 7 days a week. We've also just finished building 3 at the ingress. So that's at the entrance of Waterfall. It's been a real success. So that's what we call a collaboration hub, one office, 4,500 squares. As we all know, we've come out of an environment where office had battled. We have seen a huge uptick in demand or inquiries here at Waterfall. It was a long debate at the investment committee last year whether we should trigger it, and we did. And we pre-let that entire building before completion with some high quality blue chip tenants. So on the back of that, we have launched Gateway East, which is in turquoise attached to the mall. So that's going to be our new spec collaboration hub, just under 12,000 squares, of which the office space will be around about 10,000 squares with retail at the bottom. Very excited about this. We triggered this for a few reasons. I think one, just because of the amount of demand that we're seeing in the office space. Secondly, the way the mall was designed is that we had basements that we had to build when the mall was completed on the pocket surrounding the mall. So on that site alone, there was an 80 million rand spent capex amount that we've been carrying essentially for 10 years. So we are unlocking collaboration hubs responsibly, but we're looking at strategic sites. This made sense because obviously we are sitting on a large chunk of money that we have spent. We need to activate that. It was a cheaper entry to build an iconic development. So we are going to start construction there in the next couple of weeks, and that should take us roughly 14 months to completion. So I think the focus going forward, as I mentioned, is going to be around the mall, and then we're going to be looking at completing Nexus and Ingress. If we just look at Waterfall City from why would you come here and why is this such an exciting development opportunity? So, we talk about these 8 points regularly. I'm only going to focus on two, which we generally feel is our big competitive advantage. So the one, locality. So if you look at Waterfall City, as Jackie mentioned, it's in the middle of Johannesburg. And if you look globally, very hard to find a piece of land the size of 2,000 hectares in the middle or inside the urban edge, which is essentially what Waterfall is. Generally, developments like this are on the outskirts, and then you hope that the urban edge obviously moves over time and obviously consumes it. So that allows us to attract a wide variety of clients, and also the other guys that are developing here at Waterfall. I mean, if you look at what we can offer and other developers, Bowen are developing apartments here, roughly at about R1 million an apartment. You're seeing homes here at Equestrian Estate, which are on hectare sites. You can find data centers here, logistics, obviously a super regional mall, as Raj mentioned, and collaboration hub. So we feel that Waterfall can offer any client who's requiring a real estate requirement anything they may need. And then I think the second point, and I think it's a point I focus on heavily, is the infrastructure. Infrastructure is obviously hugely important in real estate, and it's hugely important for the economy. I think as South Africans, we are crying out for things that work, an environment that works, an infrastructure that works, and we have that at Waterfall. It is the biggest piece of modern infrastructure you're going to find anywhere in South Africa, and something that we are exceptionally proud of. Just focusing a little bit on the location and the road networks before I start talk to the logistics side of things. So you'll see in the middle of this graphic is where Waterfall City is. As I mentioned, it's essentially in between Pretoria and Johannesburg, very accessible. It's along the N1. We attract clients from across Gauteng, which I think is one of our big competitive advantages. And I think what is going to be a big game changer, which I'll focus on when I talk about Waterfall Junction, is that there's going to be the unlocking of the K113. So the K113 is essentially going to link Allendale with the R24, essentially where the old Pick and Pay facility was. And that is going to be your new north-south logistics arterial, because it cuts out Buccleuch. And we are responsible for the majority of that remaining road to be built. Essentially, it has been built from Longmeadow all the way through to behind Lindborough into the new area called Long Lake. So if we focus on Waterfall Junction, our new precinct that I think we are exceptionally excited about, I would like to hazard a guess that this is going to be our big focus from a development point of view going forward over the next 3 to 5 years. We started putting infrastructure in on this piece of land at the back end of 2018, and we'll be proclaiming phase 1 in the next couple of weeks. Why has it taken so long? Well, the infrastructure that we're responsible for, we completed about 2 years ago, but we have been battling with the water infrastructure challenges in Gauteng to get a water connection, which we have finally managed to do. So that is going to allow us to unlock phases 1, 2, 3, and 4 by the end of the year, with phase 1, as I mentioned, coming on in the next few weeks. On the back of that, what we've decided to do is that we're going to launch a spec development there of 22,000 squares. And we also signed heads of terms with a tenant-led development, logistics development of 16,000 squares. Both will be in phase 1. As you'll see there, if you look on the graphic between phase 1 and phase 2, that road that goes from north to south and adjacent to phase 5, that is the K113. So that is the road that links Allendale with the R24. I think why we're excited about this is obviously, as I mentioned, is that it is going to be sitting on the new north-south logistics arterial, but also it's the size of this land. The entire piece of land is 1.6 million squares, of which 1.2 is usable, and then that equates to roughly 600,000 squares of bulk if you use a 0.5 bulk factor. It's a large scalable piece of land. We have 150 MVA approved on phase 2. So it does allow us to meet data center inquiries. We are extremely proud of the JV we have with Vantage and LP9, which is roughly the same size as phase 2 at Junction. We are still rolling out developments with Vantage, but this obviously gives us another element with another data center provider if they be looking for land. And then really, I think if you look at logistics just generally, you know, with the inability to find large tracts of zoned service land, and you need that for logistics. I mean, at a 0.55 bulk factor, essentially, What that means is if you have 1,000 square site, you can only build on 500 squares of that. And the reason for that is in your circulation. So you need to find a massive piece of land, and then you obviously need to provide services to the massive piece of land. And obviously within the urban edges, there's limited amounts. There are bits on the R21, but at this stage, nothing of this size and it's serviced and ready to go that we have currently. These are just a couple of developments that we're working on. So the approved pipeline here, you could see the client-led development that I mentioned earlier. You then see the 22,000 square warehouse that we are going to do on spec at Waterfall Junction, and then the Gateway East development attached to the mall. And then these are a couple of developments that we have started discussing in quite detail with the clients. Excited about the potential hotel at Akerstad. And then we're also talking to a tenant on a conference center and hotel attached to the mall. Obviously, it makes sense to attach it to the Mall of Africa because you can obviously piggyback off the parking. And then this is essentially a summary of what I've discussed and where we are currently. So essentially, we've got just under 90,000 squares of total developments under construction or approved, of which the effective amount is just under 39,000 squares. So that's made up of Ellipse Phase 3, the JV with Tricult, the second data center with Vantage that will be coming online August of this year. And then the Aspire residential development, we've got a JV with Tricult. We're a 25% shareholder there. As I mentioned, launched about a month ago. The client-led warehouse, we're a 25% shareholder in that. Sanlam are the other 25% shareholder. We have the other 50% shareholding in Waterfall Junction. And then the client themselves have taken a 50% stake in that development. The LP3 warehouse, that's the spec warehouse at Waterfall Junction. Again, we're 50% of that. Sanlam, the other 50%. And then Gateway East, we are 100%, which is our new collaboration hub spec. So that totals 30,000 of effective pipeline or 660 million rand of capex, inclusive of land.
Thanks, Dave. I'm going to just provide a quick update in terms of our funding. So if you look at the slide up there, our funding has increased marginally to about 6.7 billion. But on a net interest-bearing debt basis, that's about 6 billion. We're very healthy from a liquidity perspective, just shy of 1.5 billion. And then if you look at our weighted average loan term, the graph below shows both the roll-off profile of our debt as well as our hedges. And there's been a substantial amount of work that's been done in the last couple of weeks on another refinance of all of our debt. So substantially 4.3 billion rands worth of our debt currently being renegotiated with our key funders. And this is the second time in about 20 months. The first time we refinanced, we achieved lower margins of about 35 basis points. And now we're hoping to achieve a further 14 basis points reduction on that. So a combination of, I think, a couple of things, the market being fairly favorable, but also the strong credit matrix for Attacq and our growth profile certainly playing to our strengths there. From a hedging perspective, we've got a substantial amount of hedges that do fall off. What we have been doing is entering into replacement hedges, some of them forward starting. You can also see that our hedge coverage ratio is now up to 87% from 75% last financial year and up further from 70% 6 months before that. And we've really been actively managing our hedges. And what I mean by that is we've been making sure that we have the minimum amount of coverage, but we've been waiting for the curve to reflect a lower trajectory based on various factors, most notably interest rate cuts, both locally and globally. We've now taken advantage of a lower swap curve, and that has also played to our all-in weighted average cost of debt, which is now 9.5%, 50 basis points lower than June last year, where it was 10%. I think that's the end of the presentation. We can now hand over back to Vanessa and Mark and the team.
Thanks, Raj. We're going to jump straight into questions. I might just kick off with the first one. Maybe one you've kind of gotten on the roadshow over the years. Just given how big an asset Waterfall is within the group. Does it ever make sense to, dispose of the other assets and, become a uniquely focused, REIT with, Waterfall, given all the development Dave talked about there, that, can still go on and you can like recycle that capital into maybe speeding up developments of Waterfall and doing them on your own balance sheet rather than bringing in partners?
Yeah, Mark, is a good question, and it's a question that we have received a few times over the last couple of years. It is obviously Attacq's unique value proposition. We've got a substantial completed portfolio, but like you talk about, we've got a substantial development pipeline, which we're quite excited about. But I think what we do like about the rest of the portfolio is that they are regionally dominant. They are precinct focused, which is front and fore of our strategy, and they provide a level of diversification. So if you look at Waterfall City, obviously anchored by Mall of Africa, we've got some logistics that is completed, a substantial pipeline, but largely also anchored by a lot of high quality collaboration hubs with great tenants. And what we do like about the rest of South African portfolio, it brings a little bit more retail in the portfolio, and provides us a little bit more diversification. And what we saw in COVID, during COVID and then post COVID, during COVID, what sort of carried most businesses through was the collections that we received from the collaboration hub tenants, and then subsequently, when retail was able to trade again, that picked up. But then, the post-COVID impact of work from home, flexible working arrangements, and tenants requiring less space has impacted the industry substantially. So I think having a well-diversified portfolio is absolutely front and fore in terms of our own strategy. AV partners, why do we use them? Are we using them for balance sheet, etc.? I think at a gearing level of about 26-27%, it's quite clear that we don't have a gearing issue. Our interest cover ratio is 2.9 times. So it's not really about using the balance sheet, or rather JV partners for the balance sheet purpose. We partner strategically. So if you look at our residential strategy, it's been about partnering with residential experts. That particular product isn't really aligned to a REIT model. It's a develop to sell model, but we'll take a small stake in that development. We know it's critical for the city to have residential developments, and we'll bring in an expert and so forth. Where we've had other JV partners, it's had they might have access to a tenant that would like to have been in a precinct like Waterfall, and effectively they provide the tenant, we provide the land, and we then do a joint venture. So I think we've been really strategic in how we've brought in JV partners. It will always be part of our DNA in how we roll out Waterfall, and ultimately, that'll feature in how we roll out Waterfall. But it won't necessarily mean that we're doing it for balance sheet purposes.
Hello to the team and welcome back to Unlock the Stock. It's lovely to have all of you here, and to everyone who's attending the call. Just a reminder, because I see a few hands keep going up, please do DM your questions through to either me or Mark. You can't ask them live. So the question that I want to deal with, and I'm going to ask, it was two separate ones, but I'm just conscious of time. So it's more just around the collaboration hubs. And for those who aren't familiar with your business, that would be the office properties essentially. It does look from your pre-close that there's a bit of an uptick there in occupancy rates, which is always interesting to see. I noted the development activity at the ingress and what's happened there in terms of getting that across the line. All kind of bullish around that space, and I'm just wondering how much of that is maybe very specific to these properties and that precinct, and maybe how much of it we can try and extrapolate into what's really going on out there. So the question is, firstly, do you think this is a broader trend, or are these tenants coming to you and saying, we want to be right here and we're only talking to you, this is where we want our office to be? And then the second part of the question is, with developing the ingress, how have you had to respond to any changes post-COVID? Like, do you feel like the world has now just gone back to normal? Or are companies actually looking for a different environment? Are there still hybrid working relationships out there? I think that's very useful insight, and you're right at the forefront of that.
Maybe I can give just some data insights to how the market is currently at the moment. So if we look at the occupancy, and this is also power data, our occupancy rate in Waterfall is around about 9%. That's vacancy. Yes, Raj. Rosebank is around about 8%, and then Bryanston and Sandton is between 13 and 12%. So we definitely on par with Rosebank from a vacancy point of view. Then if we look at our rental rates, average rental rates for an A-grade building, we by far charge a premium for our A-grade office space than to the other three nodes that I've just mentioned, which tells you one thing is that clients are seeking safety, they're seeking quality, and they're seeking a value proposition for their clients. So coming back to your second question is, what is it changes post-COVID? Is hybrid working here to say absolutely? We are seeing clients working 2 days, 3 days, 4 days, 5 days, hybrid flexible working policies in place. But what people have realized is we need to be in the office. So collaborating with our clients. So we've seen shrinking in offices. In some instances, we've seen expansion in offices. But what clients are saying to us is we want something that is a unique value proposition. What is going to draw an employee back to the office? That's not always just the office space. It's the coffee shop. It's the ease of access. It's the transport mode. It's everything that David has also presented on the unique positioning of Waterfall. So that's definitely become a very, very strong selling point in the ingress space. What we've also noticed is if we come back to the physical building, it's smaller space, it's more modular space, it's the agility of how can we cut up space in certain pockets. I would believe your sweet spot in Waterfall is between 1,000 and 1,500 square meter offices. In the past, it would have been a 3,000 square meter client. So that definitely we see, and clients don't want to pay for wasted space, because we have also seen that those wasted space in COVID costs a lot of money. Coming back to, will clients only look at Waterfall? Certain clients, yes, they would say, you know what, we've looked around and we prefer Waterfall and we want to stay in Waterfall. Other clients are more bargain hunters, so then we're up on an RFP. And then we need to put our best foot forward. We generally don't always want to go into from a pricing war point of view. We price our pricing. This is what it's cost to build a building. This is the hurdle rate. We can't price lower than that, but this is what you get. And I must say, we do win the RFPs, and we don't go into pricing war. We pretty much stick to our guns from a pricing point of view. So clients that choose Waterfall because of all of the reasons I've mentioned. And maybe the last point that we offer our clients is always on, which is an incredible important factor in South Africa. Infrastructure development, I cannot stress how much that plays value into premium we charge and attracting and retaining corporate clients.
Raj, I do want to just focus on the debt again if we can, because you know, we've had the big refinance, which was a major thing after the GFP deal went through, and now you're talking about relooking. And I know you talked in your presentation about the kind of basis point improvement you're trying to achieve, but maybe could we just touch on the tenor? Are you looking to like really extend it out, just given how far Waterfall is now developed, and the kind of certainty of payments? So because it's quite skinny under 3 years, so like once this whole process goes through again, should we see something more in the I know you don't want to go too far out, but more in that 5 to 7 year period once this next round of debt refinancing goes through?
Yeah, Mark, it's a good question, and I think the trade-off we've got to make, or the balance that we need to strike, is the certainty of long-term funding. You talk about a long-term asset like real estate. Should we be funding 5 years and beyond, versus the sort of incremental cost that comes with that certainty? And obviously, as a REIT, a substantial number in our income statement that impacts our distributable income, and the most substantial number is our finance cost, which is why we actively manage all of it. And so when looking at how we manage it, we take into account what our current gearing levels are, what our current interest cover ratio is. We obviously run scenarios and sensitivity analysis to that, and then we also then on top of that effectively project what the balance sheet and the income statement could look like over 3 to 5 years, and are the credit metrics healthy? But what we've done with this particular refinance is we've done a lot of sort of 3, 4, and 5 year funding. And that gives us a weighted average expiry profile of about 4 years, 3.8 to 4 years. And I'm comfortable there, because if you think about our gearing levels, they're pretty modest at about 26%. We've got exceptionally good relationships with our key lenders. There's probably 4 to 5 lenders that have been with us for the last 15 years that understand real estate really well. And I'm not uncomfortable that, in 24, 36 months, we start opening up those discussions around funding. And I think the last element to that is the debt capital markets. So we entered the debt capital markets for the first time last year, October. We had a great first outing there in terms of funding rates and oversubscription. I think we've got 5.5 times oversubscribed, and really reflective of, I think, two things. One, good credit quality coming to the market, and two, not a name that asset managers have already filled their boots with. And so I think when we come back maybe later this calendar year, there's an opportunity to upsize that. It's currently 11% of our total funding arrangement, and we can take it to 15-20% quite easily. The DCM market is traditionally about 10 basis points cheaper, but it is a fickle market. We saw during COVID that those fixed income investors wanted out of real estate at all costs, and the banks were there kind of holding various counterparts' hands, making sure that that they have the required liquidity. So there's a number of factors that we take into account. I think funding too long has a real impact on distributions, but certainly we're not going to do that on a sole basis. We've got to make sure that we're managing the book responsibly.
Yeah, just maybe a note on that as well is on the coming to market in a more public form. We've seen a huge uptake in kind of money market funds and just investors more broadly. Really putting money into that rather than holding money in bank accounts for. I don't know if they're just copying what's happening in the US, but all of that money then needs to go somewhere from the manager's point of view. So yeah, I'm sure it'll be well received if you do go down that path.
We're hoping so.
Absolutely.
I've got one that I'd like to ask around retail. I love understanding the broader trends at the end of the day, because that's what you're operating in. So I noticed in the pre-close that Cotton On has reduced its store, I think it was, in Mall of Africa, its store size. And I'm wondering if there's a broader retail trend here just around smaller stores and omni-channel models. I've been following some of this overseas, where you see some of these retailers saying, well, we need a little bit less in the way of storefront and a little bit more in the way of warehousing, so we can fulfill from warehouses. Now, what's interesting with you is you've got exposure to both. But if I understand your logistics play correctly, then it's generally quite large warehousing as opposed to maybe smaller mom and pop e-commerce type stuff. So just some commentary around how you see the e-commerce world playing out for you. What does that mean for the retail trends in and around Mall of Africa? Is it a threat? Is it an opportunity? Where do you see this?
Yeah, there's a number of questions in that you posed there, so I'm going to try go through them very logically. So firstly, let's maybe then divorce shrinking and growing in retail from maybe e-commerce or changes or disruption. I think shrinking and growing retail footprints is healthy in any way. We did that a few years ago when Mall of Africa reached its first 5-year renewal cycle. We looked at a number of those guys coming up for expiry, who had to grow, who had to shrink, and we executed. Cotton On is exactly the same story. They felt that they were oversized for the current environment. We had a fantastic opportunity to introduce Decathlon into a closed retail environment, something they haven't done in South Africa before, and we simply executed on that opportunity. So I think in that instance, it worked for both Cotton On, Decathlon, and us. So that will always happen. In broader strokes, what are we seeing in the industry, specifically with regard to e-commerce? Interestingly enough, we actually hosted a conference at the end of March here in Waterfall City. We invited all the COOs and CTOs of the big retailers. So Woolies were here, Pepkor, Mr. Price, TFG, all of them. And we actually spoke about retail in 2030. And that unearthed a number of interesting things to consider for both landlords and retailers. We're hoping to work closely with them, a number of these retailers going forward in how we play a bigger role in their supply chain, a bigger role in that sort of omni-channel experience. We certainly don't see it as more complementary to each other is what we do see. You shouldn't have to pick one. I think they can both coexist really well together. And specifically from an Attacq perspective, where we have regional dominance in places like Potchefstroom, George, and Stellenbosch, our mall infrastructure actually become critical in that last fulfillment. And I think there's a big role for us to play with some of these big retailers going forward. I also want to mention that the world of online has brought us a lot of opportunity in bricks and mortar. We've introduced a number of online first or online only brands in our portfolio in the last 24 months, and they've traded really successfully. And in that instance, once again, what we thought might have been a threat 5 years ago has now turned into an opportunity where we can use these successful online brands for new pipeline in physical bricks and mortar. On the logistics side, yes, even though our exposure is mostly to the larger corporates, we do see a big focus on online. We've got a number of examples in Waterfall City specifically where corporates have moved here, first and foremost to update their logistics profile, but then having a brand new facility, they had the opportunity to integrate the new online fulfillment world in the same facility. And I think older logistics buildings just simply don't have the ability to be that accommodating to be new business models that e-commerce bring. And hence, once again, from a pipeline perspective, I think it puts us in a good position as these new fulfillment models crystallize. Having the opportunity to build greenfields logistics hubs gives them the opportunity to design their fulfillment accordingly. So a big opportunity for us.
I think the Gus been slightly disingenuous there, saying he loves retail. In his former mortal life, he used to work in retail, so that's why he's got such a focus for all things retail. Just one other question. It came up on another session we had, and Jackie, you referenced it to, in terms of water and solar, but if we just touch on the solar, the deregulation and things like these logistics hubs have huge roofs with low utility usage. The ability of REITs, to either on-sell electricity to their customers that are in precincts, so obviously Mall of Africa, but for the buildings that are kind of much lower usage, like the logistics hubs, and I think maybe the collaboration hubs to a lesser extent, wheeling that across the grid and that becoming a future revenue line, is that something that's like in the planning?
To do wheeling, you need to be a trader, and I think there's only 3 traders in the country. So that's where the regs have not changed. So we can produce on one side, overproduce on one side, but we have not got the ability to wheel to another urban. So that's not yet there. There's only 3 traders in the country that is able to do that. So obtaining a wheeling license is very it's difficult. What we have signed up is on a power purchase agreement. So the plant is currently being built in the Northern Cape, and we have signed with a independent power producer, and they will be wheeling the power back to us, basically an offset on our account. So we're buying cheaper electricity, clean electricity, and that gets offset by our account. And that model is by far the most feasible and easier implementable model in South Africa at the moment, working around Eskom and the regs. We put as much as solar as we can on the roofs that is feasible for us for that particular client, and for the usage. It's also stupid to put solar and you're not using the whole plant optimally. So we really look at what's the optimal size. We've also not ventured into battery backup storage. It's not feasible. It just doesn't make sense for us to invest in battery storage. And we have run numerous models with our engineers on backup storage. Hopefully we'll keep close to the regs if the changes and we can wheel. The grid is very sensitive. So Eskom is controlling the ins and outs of the grid, because that ensures the stability of the grid. So I understand why they prohibit us to just wheel from logistics into Mall of Africa, and there's quite a lot of paperwork to ensure that you can wheel. But I think we've got a very optimal model at this stage that hopefully will kick in the next 12 months.
Yeah, thanks, Jackie.
Mark, giving away my secrets here. So I didn't ever work in logistics properties, so I'm going to have to ask this one, and I can promise it doesn't come from any previous understanding at all. But my understanding on some of the big warehouse space is that you would typically have like one large tenant who basically has a big box warehouse, right? And I guess when you see lumpy changes in occupancy, as we saw in your pre-close, is that just kind of, there's one warehouse now where you've just got this awkward gap while you're waiting for a new tenant? I mean, is that just a feature of the business model? And is that typically why you see such long-dated leases in the space?
Yeah.
Portfolio is quite small.
Yeah, it is a
Yeah.
small portfolio. We don't have a lot of logistics assets in the portfolio, and you rightfully point out, this assets, it might be a 10,000 square meter box. It is a single tenant. Whereas if you had a 10,000 square meter office building or collaboration hub, it might have 5 or 6 different tenants, and they don't always vacate at the same time. So your vacancy percentage is a lot less there. So absolutely, there's one asset that we are taking a little while longer than we would have hoped to re-tenant in the Waterfall Logistics precinct. But then the other one is a lot smaller. It was a midi warehouse, so it's arisen as a speculative development vacancy, part of 3 boxes that we developed. 2 have been signed up, and I think the tenants have already moved in. And it's this last one here. We've got a number of inquiries on it, but we just need to convert it, to a signed lease. But certainly not an indication. The vacancy percentage or the occupancy percentage, certainly not an indication of, call it, tenancy risk or sectoral risk. I think we're still very bullish on our precinct as a logistics precinct, and we've seen a number of inquiries for bigger boxes, 10 to 20,000 square meter boxes. So it really is a temporary vacancy, nothing that we think is systemic, either Waterfall or sector-wise.
Maybe, Raj, what you won't see or appreciate in our portfolios, we've also had a number of renewals in our logistics portfolio over the last month, and we're very encouraged with the positive reversion we've also achieved. Absolutely. In the logistics warehouses, barring these 1 or 2. So, yeah, it's just part of business.
Great.
Yeah, there she is. Vanessa is
Thanks,
back with us.
everyone. I didn't
Out
hear
of
Mark
time.
or the ghost trying to sneak another question in.
I mean, I've got them. I just know we're out of time.
Oh, shame. I'm sorry. We are out of time. So thank you to everyone who chose to spend some time with us today in this session, and a special thank you to Jackie, Raj, and the rest of the team that you brought in. It was a really great discussion. Thank you for supporting this retail investor platform and engaging with the investors. We hope that everyone on the call has enjoyed it, and if you want to watch it again, it will be available on our Unlock the Stock YouTube channel next week. So we encourage you to go and have a look and also subscribe to the latest videos. Our next session will be on Thursday, the 10th of July, and that will also feature another returning company to Unlock the Stock, which is the PBT Group. That is all from my side. Thank you again to Attacq, and goodbye to everyone on the call.